There are two major parts of accounting: management accounting, which serves only managers, and then financial accounting, which serves a wider range of stakeholders. So that's a new word. So we will go through these words. However, managers are responsible to make these financial statements. It's a legal responsibility. Every single business in developed countries, let's talk about UK, it is legal to prepare financial statements. If you do a business and if your annual turnover is more than £1,000, and if you do not prepare financial statements, in first instance you will get fined, but in worst case scenario you can even go to prison. So it's a legal responsibility of the managers, directors in most of the cases, who are responsible, and normally it's a finance director who is heading the accounting and finance department in big companies. It's a legal responsibility. It has to be done. And the issue with this, that managers are responsible to manage business and run business efficiently. And these are the reports who actually report to the outside world that business is being managed efficiently. So there are two things. Management accounting would help you to run the business efficiently. And this part of the accounting helps you to tell the world that your business is being run efficiently. Both things are equally important. Okay. Most of the companies in the world, their valuation comes from because of these statements. What you tell world is more important sometimes, especially from valuation point of view, than what the business is actually worth. So it is very important to understand these financial statements and then make decisions accordingly. Apple and Amazon, they're more than 1 trillion worth now. The actual assets of these companies are not worth 1 trillion. There may not even be $500 billion worth. But it's all up to these financial statements, what they tell the world, and then the world puts a value. We talked about accounting as an information system, and the companies spend a lot of money in collecting information, which could be used to the company's advantage, to the business advantage. As we discussed, that information is power. Our knowledge is power, whatever the case is. So just like management accounting, which actually looks at outside the business and inside the business and collects the information, processes and gives it to managers, financial accounting looks inward. It's very inward focused. It's very past focused. Management accounting is mostly outwards, not mostly, but it has equal weight importance for inside information and outside information. And it's mostly future focused. Financial accounting is the legal responsibility of the businesses is to report all of the transactions of the business which occurred in the past and present it to the company house, for example, to HMRC and to the other stakeholders, which we will discuss. So let's talk about what accounting is, or financial accounting. Okay? It should say what financial accounting involves. It involves analyzing and recording, summarizing, and presenting the transactions of any business. Now, what is a transaction? Whenever business deals with businesses or its customers, and that dealing can be recorded in financial terms, in money terms, it's a transaction. And this means any event which would cause money to leave or enter the business now or in future. Both are important. Or because of that, sometime money has already left the business or have already entered the business. Because sometimes you get money in advance. So a customer pays a business in advance, and then the business delivers the goods to the customer. The transaction is not completed until the both parties have performed their obligations under the contract of sales. That's more legal wording. But that's what the transaction is. How many customers comes in the store in a day? That is not a transaction because not all of those buy. How many people browse on our website? That is not a transaction. What is our customer satisfaction? What is our staff satisfaction? These are not transactions because these cannot be measured in financial terms. A business makes a lot of transactions every day. Even a small business does like hundreds of transactions every day. Every time a customer orders, buys, it's a transaction. Every time the business buys, sells, it's a transaction. We pay our bills, transaction. We pay our suppliers, we pay our staff, we pay taxes. All of these are transactions. All of the costs are transaction. The amount of transactions is such that even a corner shop, if you know a corner shop, it would have at least 30, 40 suppliers and maybe thousands of customers. So every time they deal with that, it's a transaction. Every time they buy a transaction, and then they have staff and so on and so on. So these are lots of transactions. Small businesses do that in maybe in thousands or hundreds of thousands, and big businesses do it in billions and maybe trillions times a year, number of transactions, and they have to record those transactions. All transactions have a source document, and evidence. Source document is an evidence basically that a transaction took place. That normally source document is a receipt from the till, or an online sales receipt, or a payment into the account, and so on, or a supplier's invoice. The businesses have to record all of those transactions. However, when this transaction happens, it affects different elements of financial statements, which we will discuss later on today. So first part is that when a transaction happens, an accountant would actually analyze the transactions and decides that which elements of the financial statements needs to be updating because of this transaction. So I give you an example. Sales is an element of financial statements. When you sell, you need to update your sales element. And because if you do it on cash, then cash is another part of the financial statement. It's not an element. Element is an asset. So the cash account needs updating. So this is the job of accountants, to analyze the transaction first. And most of the transactions, 90% of the transactions, are very clear, simple. Anybody could do it if they have a small understanding of accounting. But around 10% of the transactions are very, very difficult, very, very complex. Pensions, for example, deferred tax, leases, and so on. For that, you need qualified accountants. So mostly this kind of information is actually updated at the end of the year. So that is the analysis part. Once you have done the analysis, then you record. So for example, you record something on your sales account, you record something on your cash account, and so on. In the past, only like 30 years ago, it was a massive, humongous task because we used to do everything manually. When I started learning accounting, I'm not that old, but when I started learning accounting, we used to have registers for accounting. So we used to have 3 registers normally. One we used to call a general ledger. Then we used to have a receivable ledger and a payable ledger, which I would explain how that works. But on our general ledger, which is the main book, we would have a page for all different types of accounts. So sales, staff salaries, rent, electricity. So one page for everything. And we will have a T kind of shape. So we will have to update it. It's still the basics of accounting. If you don't understand this concept, it's very hard to understand the accounting. Maybe in the last 10 years, and we started using spreadsheets, Excel, for example, to record all of those things. And until very recently, in the last 5 to 10 years, medium to big size companies, now, last 5 years, even the small businesses, they're using softwares, and the life is very, very easy. 90% of the accounting anybody could do with the little knowledge of accounting. Right at the end, you need an accountant to finalize the account. Job done. But recording itself is still a lot of task. Every time you receive a document, you need to update it on the software. So you keep doing that. So recording is and mostly bookkeepers do that. So there's a separate task, there's separate designation or separate job in accounting and finance department where bookkeepers actually do that. Now these are normally students who are still learning and they know the basics of accounts, so they do these jobs and eventually they progress into becoming an accountant. So that happens throughout the year, and we record maybe millions of transactions after that. Now, the problem with this so far is that we have recorded 1 million sales. We have recorded 50,000 purchases. We have recorded, we have 10 staff, so we pay them every month. That's 120 times a year. And so on and so on and so on. So we have recorded all of these transactions. In their current state, they cannot be presented effectively. And the users wouldn't know, especially if they don't know much about accounting, they would not understand from all of that data how that works. So now we need to summarize those transactions. So what we'll do, we'll total up the sales, we'll total up the purchases, we total up how many assets we have, how many machinery we have, and so on. We'll total it up. So we'll summarize those. And after summarizing, we actually present that information in the form of financial statements. So presenting part is actually compiling, putting everything on the financial statements and presenting that. So that's the whole process. And mostly summarizing happens after the year end. So if your year end is on 31st of December, you will start summarizing it. And it takes a lot of time. For big companies, it takes at least 3 to 4 months to summarize all of their transactions. Small companies, maybe 2 weeks, 3 weeks, small businesses. But normally, when big companies like Vodafone or British Gas or these companies, when their year ends, it takes them at least 3 to 4 months to publish their financial statements. I remember I used to audit, and auditors are outsiders. And what they have to do, they have to audit this whole process, that how the transactions are being analyzed, how are those being recorded, summarized, and presented. They go through all of the process. So what happens when you go into a company to audit, they give you all of their source documents to you to go through. You don't have to go through all of them. And so auditors check not all of those transactions, but randomly they pick something and then they verify. So as a manager, you can't just build up the financial statements, which would make your businesses look good. Many people try to do that because it helps them to sell their businesses more expensive. It helps them to get more loans from the banks. So these are the financial advantages, which, and this is called creative accounting. It's a proper subject in accounting, creative accounting. The irony is that if you're creative in any other field, it's considered good. But if you're creative in accounting, it's not good. You need to be following the rules. No creativeness allowed. So in this process, what accountants do, they collect data from inside the organization, construct the financial statements, and that is basically considered as information for some users. And for some users, we need to actually put more processes on the information in the financial statements to create more information from that. Yeah. So you'll see that there is some basic level of information given in the financial statements. But if you want to really understand the company, just financial statements are not enough. You need to apply further processes to learn more about the company, as we will do. So today, if you have not done accounting before, you may not be able to do that. But you would be able to pick up any company in the world, and you would be able to make a good analysis of that company.